if the concentration bubble resolves in one of two ways. Either large caps fall down hard, which NVIDIA takes down the entire market because that's what the market hasn't really become, or small caps play catch up. Either one, I don't mind, right? I mean, personally, I just think it's going to be more resolved on the downside because nobody expects it.
Michael Gayed joins us today. He is the publisher of the Lead Leg Report. We'll be talking about his award-winning lumber to gold ratio. But first, let's start with his calls in the markets, stocks, Bitcoin, whatever, wherever the wind takes us today. Michael, welcome back.
I always appreciate where the wind takes me with you.
Well, thank you very much. You're not going to be on a panel. You invited me to New York, so I'll see
I
you.
did, yeah. This is gonna be exciting. And we're on
Thank,
this Friday.
Thank you very much for your invitation. So I'll see you this Friday. And where can we stay tuned for that program that you're hosting?
Yes, I'm hosting a great panel with you, Danielle Cambone, Adam Taggart, Jay Martin at the New York Stock Exchange for an event that will be really special about how to grow your social media reach and just in general become an influencer in this industry, which is not that easy to do. So I'm excited because you've got a hell of a following and you've got a hell of a YouTube channel.
Well, thank you very much. Well, it's because a great guest like you that we have a good program. So thank you for being here. All right. Well, on that note, let's talk about the market. So NVIDIA passes Microsoft in market cap today. It's become the most valuable public company. NVIDIA has a market cap of $3 trillion as a primary beneficiary of the recent boom in generative AI. A lot of new developments, the tech space, a lot of new developments with NVIDIA in particular, but more broadly speaking, what does this mean from an investor's point of view who may not even be involved with NVIDIA now that it's like the largest company out there and a big chunk of the market cap is now NVIDIA and its related AI companies? How do you feel about that?
First of all, of all the stocks I had to pick on last year, that was the stock I had to pick on the most in NVIDIA. I'm reminded of that headline from the year 2000 where Cisco momentarily overpassed Microsoft as the most valuable company, and that was actually the peak. But obviously, the NVIDIA momentum keeps going, and the reality is whether people are invested directly in NVIDIA or in broad market averages, everyone has exposure to this single stock. I mean, that's just the reality. I don't know, man. I mean, I'm still skeptical of a lot of the AI narrative. Obviously, I've been wrong. The momentum play has been very real on NVIDIA. The fundamental story has been real. I keep going back to this point that if AI is real, then three things need to happen. Yields need to fall. That may be starting to happen now, but not because of AI. Small caps need to outperform. Certainly not happening. And people forget that this stuff is going to use a lot of electricity. And the last time I checked, utilities the last 2 weeks have gotten crushed on a relative basis against the market. So NVIDIA is the poster child for what I have been calling a concentration bubble, meaning you're seeing, as everybody knows on social media, just a select number of very large cap tech stocks, NVIDIA at the top, driving the whole thing, when in reality, as I keep stressing, most stocks are still below the 2021 highs.
Well, you mentioned a couple of points of energy, utilities, and also yield. Let's start with yields.
Yeah.
So, yeah, it's been falling a bit, 4.3%. It was at 4.7% just a couple of months ago. Where's this trend headed?
It looks like the duration bear market is over. So I do suspect that you're going to see yields still continue to fall. Now, the question is, does that fall because of disinflation, or do you have finally one of those scares, right? The things you and I have talked about for a while, the risk for credit event, Japan, all that stuff sort of maybe creating it. Or just in general, an economic slowdown. I mean, the fall in yields, at least as we're chatting, is because of retail sales. I keep going back to this point. The lags do seem to be starting to hit finally. And the lags meaning in terms of these interest rate hikes actually impacting the economy. We're in that lag window. You're starting to see the effects of it. I suspect the Fed will do what it always does, which is follow the bond market, meaning they will cut rates. And if yields keep on going down, hey, that's good for all the 60-40 players because that 40, that bond side, has been hemorrhaging.
Is the decline in 10-year signaling a decline in, let's say, inflation, or are they actually anticipating the Fed to cut soon? Is that pricing that in?
Yeah, I think it's a little bit of both. I mean, the reality is, Bank of Canada lowered rates, ECB lowered rates. Like where the cutting cycle has started, even though the Fed is not the first one to the party. Now, how deep it goes, of course, is the question mark. There's this kind of interesting scenario where I think if yields fall just enough, it might unlock a lot of activity in the housing market. It might result in more building. It might result in people that have that locked in rate at 3% mortgage now actually being okay because at 5% mortgage, maybe now they actually want to move and are not worried about that locked in rate. So it's going to be interesting to see how the yield dynamic plays out. But either way, we're in a very different environment than the one we were in 2 years ago. And I think we're towards the tail end, and again, I've been wrong on this, of this AI mania craze.
We're going to continue the interview, but first, a shout out to our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below, or scan the QR code here to learn more and get started. And if you sign up using my referral link, you'll get $100 in signing bonuses. This AI mania craze has held the rest of the markets up. So
Yeah.
if we're at the tail end of this AI mania craze, can we make the inverse, I guess, logic speculation that's, well, it's going to bring the rest of the market down, or is the rest of the market now independent of NVIDIA and AI stocks?
Yeah, no, well, you said it correctly because the key word is the market, or key term is the market, right? It's like, how do you define the market when it's just a select number of stocks? It's like if NVIDIA became 50% of the S&P 500 in an extreme scenario, would you say that that's a good representation of the market? No, you'd say half of it is one stock, the other half is the market, right? Now, I do think that it is possible. I just don't think it's likely. It is possible that there's a catch-up trade on the upside, meaning the small cap side, all the breadth measures, which look terrible, suddenly start to pick up. And then there becomes this broadening out of the rally, a lot of opportunity in a lot of stocks that have been left behind as everyone's focused on AI mania. I think it's unlikely. I think it's more likely that the generals fall to the soldiers, as they typically do. But I would not mind personally seeing small caps run. I mean, this has been a part of the marketplace that has been abysmal. I would not mind seeing international emerging markets run, another part of the marketplace that's been abysmal. It's these environments of just pure NVIDIA AI only, large cap tech only, which are actually very hard for asset allocators to try to compete in.
I always like asking you this question. Broad market risk indicators. What are they right now?
Well, the main one were the two main ones were utilities and gold, right? Which utilities have been outperforming since early February. Gold had that breakout. You had that scare between Japan intervening, which, now we're back to another risk there with the yen, and then war momentarily between Iran and Israel that I think was driving some of that relative outperformance when I said the bears were in control because there was defensive rotation taking place. Last 2 weeks, you saw utilities just get torn apart on a relative basis. And gold has now shown some lost momentum. So yeah, it does look like it's a kind of risk on-ish type of environment, but again, it's risk on-ish because it's being masked by this momentum from just NVIDIA alone. Um, I suspect you're going to see another pulse of risk off in July, August. Seasonality, I think, seems to favor that from what I've seen. And we're getting closer to the election. It's like, well, we suddenly forgot that we have this thing in the US that might end up being very tumultuous. Just because NVIDIA is doing what it's doing doesn't mean that the president's going to be chosen by AI.
Well, you tweeted this. Okay, so you said this isn't a stock market anymore.
Yeah.
And you showed a chart of NVIDIA's total market cap relative to the rest of the NASDAQ. This particular chart compiled by somebody named Kelvin Mu from Translink Capital. It says here NVIDIA contributed to 40% of all gains in the NASDAQ. The other 3,400 companies contributed to the 60% combined. Okay, so let's suppose you want to diversify. I suppose I don't want to even say the NASDAQ, but let's say you want to diversify away from NVIDIA. What do you do then now? Positioning ahead of the elections, asset allocation strategies. What's your take?
Yeah, look, I think if the Fed has stuck the soft landing and if the economy is going to expand further, which I think is debatable, then you want to probably go into the biggest laggards. The biggest laggards would be what? Commodities in general, right? Because they've been left for dead in this. Energy as a sector, I'm quite bullish on. Uranium, very long term. Basically anything except tech. I mean, that's kind of the reality. All the stuff which has been left behind it's basically anything that's ex tech. Dividend stocks will make a comeback if yields keep on trending lower. So I do think you're going to see, in general, a pivot away from momentum only into total return dividend type of plays, which is a more defensive posture anyway. But I'm going to keep stressing, I'm not letting go on this idea that I still think there's a possibility of a credit event. I still think there's a possibility of Japan, the reverse carry trade dynamic playing out, which I have been wrong on in terms of how early I brought it up with you back in August of last year when I was 90 pounds heavier. But I should more of an FYI for those that are wondering who this guy is. But I think the broader point is you can make a very bullish case. The bullish case is small caps, everything else outside of tech plays catch up. It's not the most likely scenario. If you want to try to get NVIDIA out of a portfolio, you have to not have any large cap exposure at all.
Well, okay, let's talk about the lumber to gold ratio. It's been breaking down, right? I'll show a chart on the screen. It's currently at the lowest point since I think last year,
Yep.
right? What happened here?
Yeah, and that's consistent with the slowdown, right? I mean, that's consistent with the lags hitting. I mean, you're seeing it on the construction side, you're seeing it on the housing end of things, and it coincided with yields dropping, right? I mean, part of the whole idea of the lumber to gold relative relationship, which people roll their eyes on, but all it is no different than copper to gold. It tells you about housing relative to a risk-off asset in gold. Lumber is a key driver of construction. Um, when construction is likely falling because as lumber prices are falling, it probably means the demand for money is falling, which means yields are falling, right? So that's actually, I think, worked out fairly well. Now, it has not resulted in any kind of major VIX spike. It seems like every time the VIX wants to run to 20, it gets immediately smacked down, largely because it's based on S&P, and S&P is largely based
Now,
on NVIDIA.
isn't this interesting? Hold on. So we're talking about home buildings, home building stocks, home builders. Okay. So the home building ETF, the iShares US Home Construction ETF, ITB is the ticker. For anyone who wants to put this on the screen, I'll put this on the screen. It's been tracking the S&P 500 quite well up until the middle of May.
Yeah.
And then there was a huge divergence. The rest of the market kept going up. Home builders collapsed. Uh, is this a sector specific issue, or is this a broader trend of slowdown that we're witnessing
Right.
happening with the home builders first?
It feels almost like Wile E. Coyote. The S&P is Wile E. Coyote going over the cliff and just, hovering there while everything else has kind of stopped going over the cliff or started going over the cliff. Yeah, I think it's a tell on a broader slowdown. But where I go back to this concentration bubble is throwing a lot of these dynamics off.
Right. It's the S&P being, most of it
Right.
is like tech stocks now, right? That's what
Right.
that's what
Exactly.
we're talking about.
And I
That
think it was the prior week that it was like the first time ever in history that only one sector beat the S&P 500, which was tech.
Yeah, okay. So that actually is quite telling of what's going on in the real economy. Home builders are slowing down, gold's going up, and in fact, gold has beaten the home builders index, which has gone down since middle of March.
And again, small caps have not made new highs. So so it's like if that's what I'm saying. If the concentration bubble resolves in one of two ways.
Mhm.
Either large caps fall down hard, which NVIDIA takes down the entire market because that's what the market has really become, or small caps play catch up. Either one, I don't mind, right? I mean, personally, I just think it's going to be more resolved on the downside because nobody expects it.
If we were to position ourselves on the small cap front, any particular sector you would want to be in that, you would want to be positioned in, rather?
Yeah, yeah. So I'm glad you mentioned it. So I've actually been pretty hot on biotechs, which a lot of small cap companies are in the biotech space. Largely because aside from the fact that they're small caps, I think it's true that a lot of money ended up ignoring biotech companies because of the chase for GLP-1, the Eli Lilly's of the world, the Novo Nordisk companies of the world, this kind of weight loss side of things. So they've been ignored because of that momentum chasing. And again, if AI is real, I would think no part of the healthcare sector would benefit more with artificial intelligence than anything related to the body, right? So I think the biotech side, to me is the most interesting. Obviously, you got to diversify properly because there's a lot of risk on that end. And I think in general, I keep going back to anything energy related makes a lot of sense to me.
The VIX is at a multi-month low. Either the market is complacent or it's signaling no risk whatsoever going forward, or very little risk. Not, I wouldn't say no risk. How are you reading? Do you look at the VIX as a leading indicator at all, or is it more of a coincident indicator for market performance?
More coincident from the research I've done on utilities, treasuries, lumber to gold. Those tend to lead volatility. The whole risk off thing is about volatility rising. I keep joking VIX is going to zero, bro, because that's what I see on social media with the types of traders that are posting their accounts, which are probably photoshopped to some extent. Um, the look, the VIX can stay low for a while, right? And then typically when it stays low for a while, it explodes. Now you don't know when. Just because you have a low VIX doesn't mean you want to bet on volatility rising. You want to see other factors play in. But I do think the VIX and credit spreads, as I've said before, are very complacent because you're still in the lagged window of the fastest rate hike cycle in history. Small caps are clearly telling you there's still risk because they're not outperforming, not at 2021 highs. So yeah, there is a chance that you end up having a vol spike finally, and one that persists beyond 20, the level 20. But you probably need NVIDIA to go down hard first.
Yeah, this is kind of crazy. I'm looking at other sectors as well, just to
Yep.
verify what we're saying. Uh, Utilities are down from a month ago. Let's check out consumer staples.
Yep.
Uh, KXI is the ticker, Global Consumer Staples ETF. That's flat. Yeah, like we talked about, most sectors that I'm looking at are going down except tech. So when one sector is leading the pack and everything else is not only stalling but outright declining,
Yep.
um, is that a signal for either momentum more to the upside to stay in one sector, or is that a signal to short that sector because it's eventually going to catch up?
So I'm not a fan of shorting unless you were going to do it as a pairs trade, meaning dollar for dollar, you short tech and go long financials as an example, right? And play the differential. Or short market cap weight and long equal weight. But I think the implication of what you're saying is everyone's in the same. If you can't beat them, join them. Right? If you can't beat the S&P, you can't beat the Nasdaq, join them. Which means if you can't beat NVIDIA, join NVIDIA. This is, I think, probably the most overcrowded trade in history now. And again, I'm speaking as somebody who's been very wrong about the momentum. I admit I've been wrong. It is shocking to me and to a lot of people how far this NVIDIA craze has gone. It's also shocking to me that it's gone this long with nothing else really participating beneath the surface. So something at some point has got to give. I don't know when. I don't know what it's going to take. But if everyone's in the same position, I think you need to be a little bit skeptical. Not that the crowd is wrong. It's just that the crowd is wrong at the extremes. And
Yeah.
it seems to me like we're at one of those extremes.
I'm really happy I'm having a talk with you right now because I honestly I didn't even discover this until today. People talk to me about the markets going up, and you see this in the headlines. S&P continues to go up, Dow Jones continues to grind up, the Nasdaq's up, but then like nobody actually peels away the layers and just looks at the individual sectors. Right, the
Yeah.
composition of the S&P 500 is dominated by one sector, and that's going up. Everything else is trailing. That happened in 2023, and then it reversed. Everything started to go up together, and now that's decoupling again. So
Yeah.
I think the theme of our conversation is a decoupling of pretty much all sectors, the real economy from once again the S&P 500, which really just tech dominated at this point.
Last year, I made the argument that I think this AI mania will look back at it and say that this marked the blow off top for large cap US dominance,
Hmm.
which really started in 2012, where it became only about US FANG. Your international markets didn't participate as much. Small caps started really lagging starting in 2011, right? And now we're at an relative low going back to like 1998. I maintain that view. I think this is sort of the final stages. We're seeing it, the final stages, and you can see that when you look at the market cap weighting versus equal cap weighting, how vertical it looks like a hockey stick. You can see that by looking at tech versus pretty much every other sector. The spread differentials are so extreme now that you have to start questioning how much longer this can actually last.
I wonder if the broad market, if you want to call it that, has any impact on inflation itself. Have you, in your research, noticed a correlation or relationship between the equity markets and actual consumer price inflation?
Yeah, so it's actually really interesting because the transmission mechanism, I would argue, is more around housing, right? And we know shelter is a big, third of CPI, right? It's a big component of inflation. So I've always had this theory that, part of the reason why high mortgage rates haven't seemingly impacted things that much is because people say to themselves, you know what? Yeah, I'm going to pay a higher monthly rate on my mortgage, but man, that NVIDIA position is going to pay for it, right? I mean, I think what happens with equity markets does spill over to optimism in housing, right? And that may be why also the Fed probably doesn't want the equity markets, or at least the indexed equity part of the marketplace, which most people are invested in, to run away because if the S&P were to keep on going at this clip and then they lower rates, yeah, then you probably do face another wave higher of housing. You probably do face another inflation wave. So yeah, look, the inflation phases have been out of COVID, supply chain. Then it was really around stimulus and the tremendous amount of liquidity. Now I think it's really about the wealth effect.
Well, the wealth effect is still kind of strong because stock markets are still up, asset prices are still up. So are you making the argument then that inflation is still going to be sticky upwards?
It seems plausible, barring some kind of extreme, which it goes back to a tail event, right? You need some kind of deflation scare.
I've had this thought last night, just before I went to bed. I was musing by myself. I'm like, to evaluate this. it seems like, we're taught in school recessions are normal parts of the business cycle.
Yeah,
But if
without
you
doubt.
just take a look at the last couple of recessions, right? What happened in the last recession that was officially designated? 2020 was a global pandemic. We were locked down. The economy couldn't move. What happened before then? 2008, literally a collapse of the financial system
Yeah.
in the US. What happened in 2001? Literally a pop in the largest sector in the world at the time, tech. What happened before that? 1987, a collapse in the stock market. So, no, I would argue that recessions are not normal parts of the business cycle. Unless we get an exogenous huge calamity, we're going to be all right.
There's a poll done by, I think it was Gallup, right? Three out of
Yeah.
five Americans think we're in a recession right now. And you know what? I kind of get it. It's like, yeah, okay, aggregate data does not suggest we're in a recession, obviously, but
Yeah.
certainly feels like that for a lot of people that have to take on three, four jobs just to pay for the price of milk. I mean, I'm talking hyperbolically there,
No, I
right?
get it.
But
Yeah.
reality, like a lot of people are suffering still.
I mean, okay, fine. I get that. I get that argument. Not everyone's doing well, and then the economy's been slowing down for some sectors. But would you evaluate what I just said? Unless we get a huge exogenous shock, the economy is not going to tip into a technical recession.
Yeah, no, I think that's right. I think you need to, because obviously interest rates haven't done it. So, and it goes back to if it's because of the wealth effect, then you need a shock to break the wealth effect to reverse that.
Okay. Any such potential shock on the horizon that you see if we're just speculating here?
No, again, I've been wrong on this, but it seems like to me like a slow moving crisis. It's still the risk of the reverse carrier trade with Japan and the yen. I mean, they intervened what 5, 6 weeks ago, and then it reversed. They intervened again, it reversed. Now you're back at the yen level where they intervened to begin with, and for all we know, if oil were to suddenly start spiking further, yeah, I think there's still a lot of risk on the international side of things. Look, keep in mind that the more that U.S. markets act like this, the stronger the dollar will get. If the dollar keeps on going the way it's been going, if you have one of those super spike potential moves, that's going to create strain on international investors. There's going to be real slowdown going on overseas, which may explain why Europe is, ECB is cutting now in the cutting cycle. So is Canada, close to us, obviously. So there, it's more likely that a shock comes from something outside of our borders, but it's still very much in play, right? No matter what. Which is why I go back to I think the way that this resolves is more from the generals, the large cap NVIDIA type names, NVIDIA in particular, catching down to everything else, because the shock should most impact where people have made the most money.
Okay. Final question. The AI wave, some argues that's beneficial for commodities that will be needed to either supply the energy side or the construction side of the data centers, right? This is the narrative I've been hearing.
Right.
Certainly, some of the prices have reflected that up until now. Copper has hit a new all-time high before it came back down. Uranium continues to trail higher. How do you feel about base metals and uranium?
Yeah, and I've actually been bullish on uranium for like the better part of a year and a half, and largely because I interviewed a lot of people on my own podcast, Lead Like Live, talking about uranium. I think you can't really do AI very long term unless you have nuclear as a big part of that. It's just the reality in terms of just if you look at some of these estimates on the electricity usage, you can't get there without nuclear. So I think that now it's done very well, right, and certainly can't continue. So it's more of a short term versus long term. Short term, you might have a pullback, but long term, I think it makes a lot of sense, and it's largely underinvested. But yeah, there are plenty of opportunities like that that are out there. That's what I'm saying. It's not all doom and gloom as much as some people seem to equate that with me. It's just a sort of a question of time frame in terms of how you think about this stuff.
Okay. And you're still long treasuries?
My at least as of writing, or as of this interview, I say writing because I write so much. My one of my funds is in treasuries. That's disclosed on the website.
All right. Well, great. Where can we follow you, Michael? Learn more about you?
On Twitter/X and now Threads, which shockingly I'm getting some huge views on Threads at Lead Lag Report, despite all the concerns around free speech.
Okay.
Looks like Zuckerberg's got some good competition there for Musk, and then of course YouTube at Lead Lag Report as well.
All right, we'll put the links. I haven't tried Threads. Maybe I should, but
You
yeah,
should, yeah.
We'll put the links down below. Check out Michael, follow him there, and yeah, I'll see you in New York this week. Is that going to be posted on your channel? Like, where can we go to see that?
Yeah. Well, and we'll be doing some live streaming. You and I.
Okay.
I think we'll just we'll see who's skinnier from the fasting that I've done.
You win. I haven't been fasting. All right. Thank you, Michael. Good to see you as always. And thank you for watching. Don't forget to like and subscribe.